Hey guys, Akil Stokes here of Tier 1 Trading, and welcome back to my weekend trading edge video where I take you on a stroll around the markets, showing you some of the best trading opportunities that are on my radar for the week ahead, and of course, giving you some lessons that will help you push forward on your path to becoming a consistently profitable trader. In today's video, we're going to look at the head and shoulders pattern. We're going to talk about some harmonic patterns, support and resistance, breakouts, and creating a directional bias in the market. Now, before we hop into the video, do me a favor, hit that like button, hit that subscribe button if you're not subscribed already. I'm trying to hit 50,000 subscribers by January 1, 2022. And also, if you haven't done so already, write this down. After this video is done, I want you to head over to our website, www.tier1trading.com. Either sign up for the free Truth About Forex Trading workshop or sign up for the 14-day trial membership. Check out some live rooms, download some software, network with our community, and check out some free training courses as well. Again, that's www.tier1trading.com. Now let's hop into the video. All right, so this week we're going to get started with the pound yen. We're going to zoom all the way out to a weekly time frame because I want to give you guys a really big picture perspective of where we're at. It's really easy to get caught up in the pound yen's recent movement. If you go down to the daily or even a 4 hour, you're going to see a massive swing from about $1.49 all the way up to about $1.58, and it looks like this is kind of a runaway bullish trend. But if we zoom out for a minute, take a breath and gain some perspective, you're going to actually see that we're at a very interesting area. And the interesting area that we're in is going to be the area of our previous Brexit spike. And by previous, I mean like back in 2016. But if you look at the really the resistance zone that I've drawn out, we still refuse to break that level of structure. So it does count as a major and important level of structure. And the last time that we retested it, which was mid or 2018 or so, resistance held and we made our way back down to $1.24. So this is a really longer picture outlook, but if we're going to see some type of similar action, this can be the perfect place for the market to put in a head and shoulders pattern, specifically a head and shoulders top. And if you guys are brand new, a head and shoulders pattern is a classic reversal pattern in the market. It's like a multiple leg reversal where the first leg is that initial upward trend. You come to kind of a normal retracement. We then put in a higher extension, not a very long extension, but a little bit of a spike higher. And that short extension is a little bit of a clue that, hey, the bullish trend may be losing strength. We then followed it up with a deep retracement, ideally testing the lows of the previous retracement. These things are never perfect, or very rarely are they perfect. So it could be higher, it could be lower. But then we get a failed extension. So the market, instead of the market extending up, we get a retracement that you would look for to come really at a symmetrical level of the previous retracement. So this is the left shoulder. This is the head, right? This thing down here is called the neckline. This last retracement will come somewhat at a symmetrical level of the left shoulder. And then finally, the confirmation of this pattern is the break below this level. So if we can violate the 148 even handle, that's going to give us that head and shoulders top. It's going to give it to us in a very nice zone. And we can expect some further movement to the downside, or perhaps a retracement, maybe not all the way to where we initially came from, but certainly hundreds of pips of potential in that move if it were to happen. The next chart we're going to go to is the Aussie dollar. This was actually one of my favorite setups to start the week, and it never happened. And that was the story of my trading week this week. I had a few grade A setups that were at the right location, and all I needed was the reason for entry. And then I had a few other setups that were right below the location that I was looking for, and I needed them to rally a little bit up. And of course, the ones that were right before the zone reversed right away, and the ones that were at the zone continued higher, and I got no opportunities out of it. So the market can be a cruel, cruel teacher sometimes. But what we do is we right click, we erase our charts, we start over, and we look for the next opportunity. And what has recently happened here in the Aussie dollar is that we have violated a previous level of structure resistance, this peak right here. However, we are still trading below the next level of structure resistance, right? So look at this, really the extremes being the spike right here, but you can see we're kind of stuck in this zone. And when we're stuck in those zones, I expect consolidation. I don't necessarily think the market is going to reverse. I don't necessarily think the market is going to continue higher. I would expect some type of consolidation, a battle between the buyers and the sellers until the market ultimately figures out what it wants to do. And if we see that battle, we're going to see some choppy movement. And if we see some choppy movement, something that can potentially form are advanced pattern formations. We would actually have, well, I had one on the radar. We may actually have two now that I look at it. Yeah, look at that. So we have a few advanced pattern formations setting up. We're going to start with the smaller one. This would be a potential, it looks like a Gartley pattern. If this is my starting point right here, if I take my Fibonacci retracement from the swing high to the swing low, that is going to be my X to A. You can see that price action comes to my 618 Fibonacci retracement with that B leg, which means I'm on alert for a Gartley pattern. In this case, this would be considered a bearish Gartley, X to A to B. B to C right down here, and then we would expect a CD completion right at this resistance line I have drawn in right at our 786 for a potential bearish Gartley. So again, an opportunity, if I can ever find the arrow button, there we go, an opportunity where we would look to sell. And again, we're not looking to sell for a massive amount, just sell for a quick in and out type of counter trend type of move. Now, on the other hand, if we continue down from this current location, we're going to have a potential bat pattern setting up. So I'm going to erase my previous fibs right here. There we go. I'll draw one from this swing low all the way down here at 73.78 to this swing high up here at around 75.46s. You can see that instead of the 618 being hit with our B leg, right, this leg right here, X to, oh, sorry, yeah, there we go, X to A to B, instead of our 618 being hit, we only hit the 50%, and that's what's gonna really differentiate the patterns here. So instead of a Gartley pattern where I'm looking for a completion a little bit lower, or a little bit higher, I should say, I'm gonna look for a bat pattern that completes at the 886. And of course, our zone for completion is gonna be from the 886 down to our X leg. Same thing with the Gartley, it's gonna be from that 786 up to that X leg. And in this one, this would be a bullish bat pattern, meaning that I'd be looking for buys. So perhaps we get some consolidation on the Aussie dollar. If we do, we have multiple advanced patterns setting up for us, one on the bull side, one on the bear side. Aussie New Zealand is next. This one's going to be short and sweet. Really just want to give you a different look at the setup that we looked at to begin with on the pound yen. This is a head and shoulders, just a little bit more in progress. You can see that we've already had both our shoulders complete, and all we're looking for is the violation. So if we go back from here, this is going to be our move up. This is going to be our left shoulder. Matter of fact, I'll just use this on TradingView today instead of NinjaTrader. So I'll use this tool, right? And we'll just look at it like this. This move up is going to be our left shoulder. This is going to be our head. This is going to be our neckline that just formed, and we just got our right shoulder right here. So if we can violate this neckline, something like that, that is going to give us a confirmed head and shoulders top, which means we should look for selling opportunities. And if you look at kind of the structure swap or the ice zone that this head and shoulders is forming at, it's pretty interesting, right? Obviously, this is the neckline, but you're going to see, we're going to see support, support, support here, support there. Before it was support, it acted as resistance, 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 resistance. So a pretty important level at the market. And if we can break this level, we're probably going to come right back down to our previous level of inside structure, which is going to be right here around 103.50. So some pretty decent opportunity here on the Aussie New Zealand. Next up, we're going to look at the dollar index. Dollar index has actually been pretty interesting lately. I don't know if I put this in one of the weekend videos or not, or just a post on TradingView, but we recently had a Gartley pattern form on here, which just hit on the nose. And although the setup that we're looking at, it doesn't really take the Gartley pattern into account. I guess it could be, because the Gartley pattern, this is a bearish pattern, so you would have sold at the highs there, and you're looking for a move lower. What we're going to be looking for here on the dollar index is a move lower as well. So I guess you kind of can use it as confirmation. So a few things happening here. One, we know that we have a pattern, and all patterns are going to have a starting point. That starting point is going to be a previous level of structure. It's going to be our X leg. So we do have previous structure looking left. Again, we can look left all the way over here on the side of your chart. We can look recently. We can look at the X leg, and we can look at the previous level that price has come to and held, right? So we're holding at structure. when we got to that structure, we have a few other things happening, right? We have a few inside bars happening, right? Inside bars are, they can be trade entries, they can be a strategy in its own right, but in general, they're going to show us that there is consolidation, meaning that the market is trending, or not trending, but moving within the range of the previous candle. So if this is the previous candle and we have a bar that completes completely inside of it, it kind of gives you the visualization that this is happening, which is basically going to be some type of consolidation. And then we ended the week here with a lower low, lower close, which if you've been paying attention to these videos, especially the ones we did maybe a month or so ago about daily and weekly predictions, that's a pretty good weekly prediction of a breakout out of that consolidation and perhaps a potential move lower. So we get all that from the higher time frame. Again, this has nothing to do with actually placing a trade, but just forming our bias on the market, kind of understanding what side of the market we want to be on. And man, I got a great Instagram message the other day, and I apologize. I forgot on my phone next to me, but I forgot the handle of who shared it. But she repeated this pretty awesome quote, and then I realized it was something I said, and I was like, oh wow, that sounds pretty smart. Akil doesn't usually say smart things, but something I say, and this goes following the whole IPDE process that we seem to talk about in each and every video, is that the goal of the higher time frame isn't to find trades, right? My weekly or my daily, whatever your higher time frame may be, the goal isn't to find trades. I'm not looking on that to find trades. I'm strictly looking to do analysis. So I'm looking to see, where is the market at? What is the market doing? And kind of based on that analysis, which direction do I think is more likely to happen? Because what we want to do is, once we go down to our trading time frames and our lower time frames, we want to have a bias. And we want to have a confirmation bias, a positive one, not one that's based off of the news or our best friend or some Instagram post. We want to have one that's based off our analysis in the market. And why that confirmation bias is important, because, and I've gone through this in my rookie trading days, and feel free if you want to share some of your war stories as well. But as a newer trader, I was simply hunting for trades, right? I was just clicking random charts, random time frames, just hunting for, where can I buy? Where can I sell? Where can I buy? Where can I sell? Where can I buy? Where can I sell? And what happens is, if you look hard enough for something, you'll find it. But I was wasting a lot of energy because I wasn't really focused on one side of the market. Half my energy was being focused on reasons to buy. The other half was focused on reasons for sells. And you can imagine that I didn't have kind of grade A opportunities. I was splitting my efforts. So the point of that higher time frame analysis is to lock in on a specific direction of the market. And then once we go down to our trading time frames, we're only focused on that specific direction. And instead of taking 50% of our energy for buy reasons, 50% of our energy for sell reasons, we're 100% locked in on a specific direction. And that just allows us to see more details and have a little bit more conviction in what we're doing. So if you don't have a type of process that does that already, I highly recommend it. And again, the IPDE process, identify, predict, decide, execute, it's 4 steps. It's rather simple. I don't think there's a easier one out there, but if there is and you feel like sharing it, do it in the comment section below, and we can read through and I'll share it in next week's video. So I'm locked in on a bearish bias here. And when we go down to the lower time frames, the daily, and let's go all the way down to a 4 hour, you can see the little double top or really triple top here on the daily. We go down to the 4 hour, we've got something else forming, right? We've got the market doing some action like this, right? Swing low, right? So extension down, retracement up. Extension down, right? Equal lows, retracement up. Extension down, essentially equal lows. And we've got 3 times our lows have hit this area. However, on the upside, we have our highs getting lower and lower. And this is called a descending triangle. This is a pattern formation where I would predict that the likely direction of future movement is going to be to the downside. So again, you can see how that higher time frame analysis now supports the actual trading signal or reason that we see on our trading time frame or our lower time frame, and that's how you want to have everything aligned in order to find the best trading opportunity. So I've talked about this 5 million times in this video, but there's 3 ways to attack these type of patterns. We get new people each week, so I shouldn't just say that, but there's 3 ways to attack these patterns. You can enter before the breakout, which would mean position yourself while it's still consolidating in anticipation that we're going to get a breakout to the downside. During the breakout, so if you're a breakout trader, put like a sell stop underneath the breakout. So as soon as that bad boy breaks out, or if that bad boy breaks out, boom, you're going to be in as soon as it happens. Or of course, you can take the most conservative route, which is waiting for confirmation. So you wait for the confirmed breakout, and then after that confirmed breakout, you wait for your reason for entry. There are pros and cons of each, so don't ask me, which is the best one. There is no best. There's no best anything in trading. It's all a give and a take. The more aggressive you are, you're going to get in every win, but you're also going to catch every loss. The more conservative you are, you're going to pass on some of those losses, but you're also going to miss some of those wins. So it's a lose-lose, win-win, win-lose. It's a balance, and that's what trading ultimately is. So hope you guys enjoyed the video. Remember, head over to www.tier1trading.com. Check out that free workshop we have on the truth about Forex trading. And also, you have some time, make sure you sign up for our trial membership. It's 14 days. It's risk-free. You get access to software. You get access to training videos. You get access to our great community of traders, live rooms, all types of stuff. All it does is cost you $1. And the reason we charge $1 is because we found out by charging anything, it keeps the trolls away. And that's how we keep our platform full of people that actually want to get better at trading, and not just, Pipzilla and people out there that are bragging and trying to sell you stuff, right? Junk. Anyway, hit that like button before you go. If you have any comments or questions, leave them in the YouTube comment section below. I'll see you guys next week with Trading Coach Podcast, midweek markups, trader coffee breaks, and of course, the weekend Trading Edge video. All right, until then, plan your trade, trade your plan, enjoy your weekend.